Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Kyle York, the founder and managing director of York IE. Kyle has his own Practical Founder success story, which we're going to hear about. But now with his prize money, he's a very active investor in B2B SaaS companies, including with his practical funding, helping serious bootstrap founders go to the next level. York IE also has a scalable services arm with hundreds of employees that provide team and talent and operational support for the companies he invests in and for other companies. So Kyle is an experienced B2B SaaS leader, and now we're going to learn a lot of lessons about what he's seeing in growing practical SaaS companies that'll be very useful for practical founders out there. And we're live with Kyle York of York IE. Welcome to the Practical Founders Podcast, Kyle.
Thank you for having me, Greg.
Awesome to have you here. You've been growing software businesses for years, and now you're a practical investor and, let's say, a service provider, a helper to practical founders and funded founders here on the go-to-market side. So we got a lot to talk about today. And it's not often that I meet investors that speak the practical funding language as their first language. But Kyle, we'll just talk about the things let's see, where are we going to start here? Why don't you give us an overview of your company, York IE, that you created after years in the software business, and then we'll go back a little bit to your history and talk about all the topics.
Yeah, that's great. I think you definitely also don't see the practical founder, practical investor at the stage that we tend to focus, which is the earliest, right? So quick little bit about me. I spent my career in go-to-market leadership and business leadership roles in software, in the SaaS business model, subscription businesses, all the way back to the early 2000s when SaaS was first created. That's where I've lived and breathed and loved it.
So it was SaaS back then. Yeah. This is an often question.
Well, yeah, it's a great question. I mean, I look back on it, and the first job I had at my first ed tech software company was converting its customer base. It was ed tech, so it sold private school software operating systems.
Oh my goodness!
And the first job I had was to call the clients and upgrade them to the new platform that was now a annual fee from a license maintenance, kind of services business. So, obviously really early on had to get sharp at, what is the ROI and business value of that model and, of kind of leasing or subscribing to something that was always going to improve and get better. They had to believe that. Right. But it wasn't, it wasn't called SaaS, if you think back to the beginning of Salesforce.com had like the no software
cloud
campaign and it was more like you talked about it a lot more back then, like managed service or even though it was software, they didn't have terms like tech enabled or subscription in the same regards. But it was a great fertile ground. And obviously doing that in ed tech with the seasonality of ed tech.
Oh my gosh.
And selling to schools where like some were Montessori schools and some were, the biggest prep schools, boarding schools in the country with endowments that were massive. You were kind of selling to the teacher, and then you were selling to like Bill Gates, who was running a project at Lakeside School outside Seattle, right? So it was a very awesome learning experience for me. But it led to a lot of my that business was bootstrapped, self-funded. I then ended up in a company called Dyn, which was an internet infrastructure company that we scaled up to 100 million ARR and sold to Oracle. And we had bootstrapped that business of 30 million. And all that experience led me to start advising and angel investing into lots of different companies that manifested its way into my new firm, York IE, which I say is new, but we're over 4 years in, almost 5 years in. And I had this vision to create a one-stop resource hub for private companies who wanted to focus on practical scaling and pragmatic growth and needed help in go-to-market and R&D and G&A and all the building blocks to build a company, and that we could build an infrastructure, advisory as a service is what we call it, a subscription business model where we could provide tech-enabled services bring a lot of like kind of data, infrastructure, technology capability. We also have a large offshore team to keep costs low for startups and be an extension of the operating teams that we were working with. And I wanted to do both, right? I wanted to still build a company and be an active operator, scaling my own business as a CEO, but also I wanted to invest and I wanted to
Yeah.
put skin in the games and into my favorite founders and my favorite markets and industries. And that's where we also built our investments practice, our venture capital practice, where we are a early stage, think pre-seed, seed, B2B SaaS investor. And similarly to my career, up and down the stack, we'll go into vertical software, horizontal apps, data platforms. But because Dyn was an internet infrastructure
Yeah.
player, we also have a lot of heritage in cybersecurity and cloud.
Okay. Well, that's a lot going on here. So you've kind of played the game, won the prize, get back on the field helping practical founders. And, some of them probably go long. You invest early and you don't know which one's going to be the home run and which one's not. It's one of the conundrums of the VC game. They have to invest early, and they're expecting big returns, but you don't really know who's going to go big there. So for our early stage SaaS founders, sometimes they need funding to get to the next important milestone of dev and sales growth or something like that. But most often they need just help, right, to get it done, right? So they use the money to buy the help and you show up with the help. So you're kind of doing both things there. Are most of the companies you're investing in using your advisory as a service, or are they, it's a la carte and, sometimes they go together. I imagine you invest and then they say, now I got to go spend money on this. And you look at what they want to spend money on. And it's probably a waste
we
of time.
don't force it, right? I mean, it's not in our term sheets. It's not,
Yeah.
I think it's why certainly the operational experience plus we have a 200-person infrastructure, right?
Yeah.
I think in a breadth of services. So I think the reason people want us on their cap table or as a partner from an investment perspective is because we actually add value. And I think in the earliest stages, whether you're bootstrapping or raising friends and family or angel money or like non-institutional money, like you're looking for smart money, hopefully, and help. And yeah, it's nice to have smart money, but smart money tends to be more on like strategy and guidance and not on actually like taking the gloves off and doing work. And that's what I tried to create is a lot of infrastructure, playbooks, templates, tools, processes so that we can help companies on repeat and actually, do work, right? We call it hands on keyboard, like actually do the work. So, we don't force it. We have over 125 clients. The majority of those are not investments. So that's a little bit of the inversion of our model. Like there's a lot of like VCs and growth equity, especially more like later stage growth equity, private equity firms who have like operating partners and value creation teams for their portfolio. Our idea was create the operating infrastructure that yes, our investments can benefit from. And I'd say they're a little bit more like malleable and bespoke. They tend to like pop from service to service where needed and scale up in different services, scale down in different services, where the direct client is typically just coming to us for like a very surgical need. And, those also tend to be a wide spread of idea stage to, someone told me the other day, our biggest client is a $200 million private tech company that's PE owned, and it's like, oh, interesting. And they're looking at us more as a near third party who can provide efficient resources to help with growth. So it's kind of like everything in between, if you know what I mean. But I'd say, just to answer your question more explicitly, I would say like, 75% of our portfolio is taking advantage of some advisory capability at some point in time, even without the additional subscription to our services. We think we're the smartest, most helpful money they've got involved in the governance and, kind of advisory side anyway.
Right. Well, it is unique. You see the money which stays with the money, right? And they offer strategic therapy sometimes, and sometimes it's good and very beneficial.
The other thing, Greg, that's I think really happened to us that's been a boon on our advisory business and our investment business, because you think of it all as a flywheel, right? Like we put out a lot of content and curriculum to the world, including doing podcasts
Your
like
own
this, right?
go-to-market.
Our own go-to-market, and that drives a ton of top of funnel. And we then need to have our own go-to-market processes and pipelines and forecasts and to you kind of consume and convert, right? And so we see just an incredible amount of founders, operators, executives But even more so lately, which has been unique as we've scaled, is we're actually finding that VCs, especially in this market, in that goes VC, Series A, Series B, Series C, growth equity, private equity, are all being asked, what value do you provide? And so they're coming to us,
White
and
label it, yeah.
we're creating an incredible amount of like really, really amazing partnerships, which, eating the dog food we're seeing in the market around
Right.
ecosystem led growth and referral based go to market motions, sales motions. That's our number one path to advisory clients now, is partnerships with
I
major
bet.
and minor investment groups and or financial services institutions that are saying, hey, you guys could be like an insurance policy for us, as well as value add that we bring to our companies. And so that's been huge. That's been a huge boon for our business.
So why hasn't, in the big and long history of tech and funding and venture capital, why don't more venture capital investors get into the operational help side of things? Because private equity has their playbooks, and you've
Yep.
got the playbooks, and you're malleable there, like probably more
Yeah.
malleable than a private equity. But why do you think almost nobody has ever created an operational delivery system like that?
I mean, listen, I think this is really hard. I recently met with one of the founders of Bain Capital with Mitt Romney, a guy named Bob
Yeah,
White. He's the HBS professor. He's
yeah,
outstanding.
sure.
And he was hearkening me back to the founding of Bain Capital out of Bain Consulting, and
Right.
talking about all the reasons back in the 70s and early 80s they did them separately.
Yeah.
And predominantly, I'd say the business model of a venture capital firm versus the
Right. There we go.
business model of a professional services or advisory as a service firm are just very different.
Yeah.
It's a 2 and 20
Yeah.
industry where
On the
to
investment
educate,
side.
yeah, on the investment side, to educate the audience. That's every fund, no matter its scale, typically charges some range in averages around 2% management fee that they charge its LPs or its investors every year. And then they take 20% profits interest or carried interest on the returns of that fund in the end. So they're getting paid to manage, fundraise, manage, and
Yeah.
deploy
Asset
money.
management.
And then they have aligned incentives with companies to hopefully,
Yeah.
reach the mountaintop of some scale. Well, that 2% management fee, and that's an annual management fee. You have to think of it like, how big of a fund would you need to actually staff a team of resources?
Right.
At the salaries and wages
Yeah.
fully
Yeah.
loaded, benefits, healthcare, 401k, everything, right?
Fancy office.
And if it's the office, and it gets very, very hard to scale unless you've stacked funds and your AUM is in the high hundreds of millions into the billions. And that's why you see the Insight Venture
Yeah.
Partners, the Warburgs,
Yeah.
the Thoma
Yeah.
Bravas, the Vistas, the big PE can afford operational engines and teams. So I think that's number one. I think number two, it's also like it's a DNA thing, right? I am happy. I was fortunate to have very early career success and
Mhm.
create a foundation for myself. But I also was fortunate that it was so early that I had to look at the horizon of the next 25, 30 years of my career and say, what the hell do I want to do? Right. And I certainly didn't want to retire as an operator. I wanted to still be an active operator
Yeah.
that created something that was able to work across the portfolio and invest as well. I don't think that's necessarily the MO of a lot of people I meet who go from
Yeah.
operator to
Yeah.
VC. A lot of them said, hey, I did the hard stuff and I reached the pinnacle, and now I'm, and again, maybe that's a little bit ageism on my part, but
No.
it's looking at the horizon a little bit differently. And again, I don't bemoan anyone's like track there. It's just, I didn't want to hang up the cleats on operating, and wanted to maintain my relevancy with founders. I struggled a lot in the boardrooms I sat in with the VCs or the growth equity people who have never sat a day in the shoes of a
Yeah.
CRO or a CFO or a CTO or
Yeah.
any operational function of leadership. And then secondly, I really struggled with the ones who hadn't operated in 25 years
Right.
and tried to tell me about modern cloud adoption or subscription business models or new school go to markets or pricing strategies, when literally it's just like them just pattern mapping you across the portfolio boards or reading it in a book or listening to it on a podcast, right? It's
Yeah.
a lot harder when you're here trying to live it.
Well, that's right. And that's what our practical founders listening are dealing with. And they feel that when they talk to VCs. Most of them haven't been in the seat, and they have their own business model, and that 2 and 20, and you got to be a unicorn, power law, go big or go home kind of thing doesn't fit practical founders. And you exist in that zone where they say, let's talk about your investment side at York IE.
Yep.
A SaaS founder gets on the field, gets into revenue. You're doing early stage,
Yep.
and you're doing it in a more practical form. It's still an organized investment, not just you
Yeah.
writing angel checks. But you don't have to create a unicorn
Right.
to succeed in your model. Let's just briefly talk about your kind of
Yeah.
practical funding swim lane there.
Yeah, it's a great thing to talk about because I don't think you talk to a lot of professional investors who
Yeah,
necessarily talk this way. Again, until you're like a later stage growth equity, private equity playbook.
right.
What I've seen is that there's a mental health epidemic in early stage startups and founders.
Hmm.
There's also a ton of vanity that drives that pressure. And what's basically happened is a lot of what used to be early stage funds have had success in the
Yes.
last few decades. And all they've done is become multi stage funds where they have everything from, early stage in air quotes to private equity funds in
Yeah.
essence,
Uh-huh.
right? That are
Right.
buyout funds. Because of that, these funds have gotten so large that the amount of capital they need to deploy in each company has gotten so large. Those rounds they're participating are so large, and founders are worried sick about dilution, right? So the
Yeah.
valuations have been frothy, right? Even in a correction, they're still
Yeah.
frothy, and
Yeah.
so you end up creating almost like the need for binary outcomes, right? If you're a
Right. It's all
startup
or nothing.
founder,
Yeah.
by how much you raise, right? Like no one invests in you to give me a 1.2% return in 10 years, right? They're hoping that you can be a 10, 20, 30, 50x,
X.
maybe even a 200x fund returner, right?
Mm-hmm.
So, and there's nothing wrong with that. That's venture capital. That's venture capital power law. That's the 2 and 20 model. It's an industry that's worked. It's made riches for many, right?
Yeah.
From the
Yeah.
investor to the operator. For me, it's just more when we set out the course to build this modern McKinsey with a venture arm for
Yeah.
startups.
Okay. There we go.
I felt like I'm a capitalist, but there was an altruistic side of like how can we create something from a platform to services to investments that can impact as many founders and entrepreneurs as possible. And success is a relative measure, right?
Right.
Like not everybody wants to be Mark Zuckerberg or Elon Musk or
Right.
Jeff Bezos.
Right.
Yet that's in essence what is put in front of us, like for all of us to be, right?
Right.
And you can like parallel this to music, and like
Yeah.
you need to be Taylor Swift or
Right.
U2 or the Rolling Stones, or you can parallel it to sports. It's like we're not all going to be Tom Brady or Patrick Mahomes or LeBron James, but yet that's like the pinnacle, and that's the vanity. And I think media has really pushed this, right? Because
Yeah.
what you typically read about is massive funding rounds,
Yeah.
massive paper valuations, what the tier one venture class is playing in, and everybody else is sort of left behind. So
Yeah. The
we,
silent
we
majority.
yeah, so we invest in 10 to 15 B2B SaaS subscription businesses every single year. We
Hmm.
invest at the pre-seed to seed stage. Typically companies are doing $500,000 of ARR or so, and they want to put fuel on the fire on their go-to-market and their tech scaling capability. We are writing around $1 million check, and we're participating in rounds that are $2.5 to $6 million. And so it's kind of like a tweener, and I would say the majority of them are more like 2.5, to $3 million,
Yeah.
right?
Right.
And we're typically in the single digits valuation to the teens, high teens
Okay. Okay. Yeah.
valuation range. And we're doing everything, like I said, from vertical industry software solutions all the way to infrastructure and cyber. Obviously, infrastructure and cyber just cost more because it's more deep tech, more deep IP, and those are some of the companies that tend to be more on a path of like traditional venture capital
Right.
playbook,
Need
right?
more funding.
So we have a spread. So what we tell our investors, our LPs, and we're always looking for more. So any of the listeners
There we
who
go.
have had exits, give me a call. But we run a rolling fund, and what we tell our investors is that we're going to give you an index of early stage B2B SaaS. And we said, keep doing your angel investing and keep doing the stuff you're doing, but we're going to give you, invest with us for a decade. You're going to have over 100 company portfolio via York IE. And so a big part of that portfolio is, have the index, have the spread of investments, limit the losers by
Right.
providing resource and capability around them to help them be efficient and thoughtful and focused on milestones and metrics and go to market and efficient scaling. And guess what will happen? Outliers will also emerge, right?
Yeah. Big
And
wins.
but we don't like to ever invest when we see like you've seen it, the slide in the deck that's basically like, here's our Series A, here's our Series B, here's our Series C. It's like those are your milestones. Like raising money, raising money is not a milestone. Like tell me customer counts, tell me ARR, tell me ACV expansion, tell me about your retention, right? And these are the things that I think, regardless of path, whether someone stay on the investment side, whether someone's raises the last money from us in that round or goes on to raise 80 million and go for it, we want the preservation of the optionality along the way. And we're not against going for it. It's just you need to have the metrics to prove it, and it needs to be less vanity and more pragmatism, even with that next stage of capital to go for it. And so it's just a different
Let's
way
talk
to look
about
at it.
that. Like when you say optionality, you mean optionality for the founder, which no
Yes.
VC would ever talk about. Like,
Oh
hey,
yeah,
what if?
I'm not talking about for the investor. I mean, literally, like my thing is like especially in our model where we're working with lots of founders and we've got a deep infrastructure and we've got an advisory business for
Yeah,
non-investments. Like we can't run these companies, and I feel like so many VCs almost act like you can just run the company or replace the founder or hire from your network, and it's like, yeah, that's all like additional incremental ads to put people in companies, but like you can't actually run it, especially at the like pre-product market fit or early go to market stage. Like you need that institutional
crazy founder
knowledge and
who,
that,
yeah, yeah,
yeah, like so I think it's really that lens of the world and trying to make sure that the preservation of optionality should mean kind of like I can bootstrap if I reach
yeah.
these milestones. I could raise another 2, but not 10. It's like I actually wrote a blog once on New York IE's blog. It was about like the stages of startup business growth, not connected to fundraising rounds,
Right.
right? So like, what would you call it if it wasn't a seed, Series A, Series B extension, Series C? Like what would you call it, right?
Yeah,
And so we went through like its genesis stage to,
yeah,
you're right, like the foundational stage to incremental. I can't remember all the exact steps,
yeah,
but
yeah.
it was an 8-step process to the sustainable business model at the tippity top. So preservation of optionality, and we lived this through Dine as we scaled to 30 million ARR, was like, I wanted to be able to answer the phone when like an M&A inbound happened and be able to say,
Yeah.
I don't know, is this good enough? Are we ready? Are we sick of this? Do we think that's the next platform for our next phase of growth or not?
For you, the founders,
For
yeah,
you, the
yeah,
founder,
yeah,
and not be stuck like, our VCs will never vote for this because,
yeah,
we raised at 200 million and they're only offering 150. It's like, that's chaos to me, right? Because in the end, that 150 for a 20% founder owner or two owners who own 50%, it's a hell of a lot of money, right? And
yeah,
I think we've like lost also that, and maybe it was me growing up in a small family business
yeah.
or, growing up in kind of a middle class upbringing, did really well. My parents gave us everything we needed, but I also valued the dollar. And I think, we like poo-poo founders who sell their company for 10 million or 25 or 50 or 75 when like those are incredible outcomes. And most of those people on the backs of those exits never have to work or do anything ever again if they don't want to, right? And they're creating wealth for multiple generations of their
Right.
family and future families. But yet, it doesn't get the headlines, and that's what I mean about all the
Yeah,
vanity
there's the
metrics get
practical founder
celebrated.
story
Yeah,
right there. Is you
yeah,
can create impact in the world, change an industry, grow a team and a community, and get life-changing wealth. And that is not at all interesting to VCs when you sell it for 75 million, 100 million, 50, 20 or whatever. But
no,
in
it's
your model,
hilarious.
just
I
to
mean,
be
when you
clear
hear
here,
like lifestyle or when you hear
yeah,
like lifestyle company or boutique or bootstrap, like
yeah,
VCs say it, and it's like as negative as a tone
yeah,
as
yeah,
you can get, right? Like when like someone, your neighbor says it, or your a family member says it, or you're an old professor says it to you, it's actually like endearing. They're like, wow, you've been able to build like
Yeah.
that's so impressive, and it's so funny. We operate in tech, especially in startups, especially in this Twitter slash X like microcosm where like the rest of the world doesn't care and doesn't
About
look
your
at
funding
you through the
round.
same
Yeah.
lens. Yeah,
Yeah.
they don't. They actually think it's silly, and they actually think if you've raised a lot of money that it must have all gone to your pocket too, right? Like it's
Ah,
like and that's another dynamic that's fascinating out there.
yeah. Well, that's awesome. So when you invest early and you don't have crazy valuations, and like a crazy business model, it's the VC business model of the 2 and 20 and the big
Yep.
funds and all of that that drives the big checks and the big exits and the power law and the all or nothing. But a founder could show up and say, "Well, we raised 2 million, at 10 million
Yep.
valuation, something like that, and we just got an offer for 50, which is
Yeah.
let's in the 5x. Let's just
Yeah.
generalize here. Like that's good for work or 30 million exit or
Yeah.
something like that. Like that works in your business model apparently.
Well, it's all. I think the way you got to look at it is it's all the context of that company's trajectory,
And
that
that founder,
market,
yeah,
that industry, that founder. And I think what has happened in traditional venture, institutional venture, is that they want everybody to be the exact same, right? Like it's kind of like I'm going to underwrite every deal that it has to be $1 billion company, and
right.
it's
That's
like
silly.
well, there's a lot of like dynamics and contextual components that you're not paying attention to, and I think we try to look at that like we call it the market in approach to company building. We try to like look at that like outside in, where a lot of
Yeah,
companies have been founded by technical founders and are like very product feature set out, as well as try to look at it like, based on time and space, and like each independent business like has a lot of inflection points,
yeah,
and those are like not the same. And I think we look at that from a very operational lens, like an operational and emotional lens. And I actually think this is a much more like high EQ game than 99% of the venture capital private equity sector actually is. They're financial engineers, they're quants, they're looking at return profiles, which in the end, again, it works. That industry works. I'm not saying it doesn't. It's just for the founder, for the
there
entrepreneur,
we go.
it's a tough life and existence that you know I have a lot of scars
Yeah.
over my history there as an operator, and you just learn from them and you adapt and you try to create something new and unique.
So thanks for saying that. That's really in support of the founders themselves and their goals and what the market is, and not putting the VC business model on it. What kind of, let's talk, you say you're appreciating that the growth game isn't a spreadsheet financial, math, simple math here. What kind of founders are you investing in at the early stage? They've got revenue and proof, and it's vertical and horizontal.
Yep.
How are you applying your philosophy of it's more than just spreadsheet math to filter the kind of founders you invest in?
Yeah, listen, we're never going to bat 1,000 at the
Yeah,
pre-seed seed stage, So, but we've established a pretty amazing process. I mean, prior to even launching York, I had a portfolio of over 65 companies that I evaluated,
yeah,
right? And by doing that, talking to lots of founders, meeting lots of founders, supporting lots of founders,
yeah,
you get good at it, right? And then
yeah,
number two, at Dyn and at Oracle, at Dyn we did 11 acquisitions. We divested 4 product lines. We had incredible partnerships with the biggest technology vendors in the world, and I led all of that, right?
yeah,
So you also have like that. And then at Oracle, I ended up being the GM of Oracle Cloud division called Dyn. We use it
yeah.
as the
Mhm.
sort of dev tools roll up. And I also ran product strategy for Oracle Cloud and all partnerships and all M&A. And we evaluated tens of billions of dollars of M&A for Larry Ellison and Safra to
Yeah.
yay or
Uh-huh.
nay, and did some great M&A while we were there. And those processes we've sort of like obviously from Oracle, like
Yeah.
stolen but downscoped and made more
Right.
high urgency startup relevant. But that's helped us kind of have a really good lens on this. There's a part of our process that's certainly around like founder market fit
Yeah.
and clearly York IE philosophy alignment, right?
Hmm.
And I think that's the nature of our business is to build relationships, because at this stage we're at, there aren't a lot of metrics to look at, right? So
Right.
you have to bet on people, And again, we're not going to bat 1,000, right? And not every company is going to be successful. And there might be some founders who are listening to us who we've backed, who we only backed once and didn't keep alive, who are mad at me, right? But we kind of look at every situation, every founder, every opportunity uniquely as best we can. And
Yeah.
then again, try to get wins in the win column and take companies to some relative success. We do have a lot of breakout stars though, too, right? Like when you
Yeah.
have an index, there are going to be companies that go from 0 to 10 million in 18 months. And you're like, holy cow, this is working. Yeah, you're right. We should raise a Series A,
Yeah.
and we should go for it. And so, but it doesn't mean do that and then become like loosey goosey with your financial model or your
Right.
business model. And, it doesn't mean go burn 2 million a month. If you just raise 10, you'll be out of money in a few months, And I think that's the dynamic that's gotten a lot of companies in trouble. But it's also weird because it's been rewarded, right? If you look at like S1 filings in the IPO
Yeah.
market prior to the last couple of years, when it's been pretty closed, M&A, IPO has
Yeah.
been
Yeah.
pretty closed.
Hmm.
But prior to that, I mean, companies were burning money on fire and still being valued at,
Hmm.
25, 50,
Right.
X their ARR, right? So,
Yeah.
I get it's confusing to those who want to be practical. What I would say to founders is like, just be very clear-eyed and understanding what it all means. When you raise money, you are bringing on business partners,
Yeah.
and you are selling a piece of your company to a bank,
Yeah.
right? There, and I think you really need to understand their economic models, their
Yeah.
timelines, what they're playing for. It's just, I feel like some people do it and then they're like, oh man, I wish I didn't do it. And I get founders who call me from the days of me angel investing and advising a decade ago, are like, oh, I should have listened to you. I went down this path. I got multiple acquisition offers. I never could take them,
Yeah.
and now I'm like in no man's land that I don't know what to do with the business. Right. And it's like, well,
Yeah.
eventually those funds are going to shut and they're going to say, you need to sell. Right.
Yeah. Yeah.
And you might sell for 50 cents on the dollar, but it's at least a new path in your journey.
Yes. Right. And 50 cents on the dollar to a VC means the founder walks away with nothing. It's cleared.
Right. Well,
Right.
that's the problem. You
Yeah.
have, again, back to understanding this, you have preference stacks, you have liquidity
All that
preferences,
stuff.
you have,
Right.
there's a whole cap stack that lives in the world. And then there's the governance associated with like who makes the calls and who makes the
Yeah.
decisions. And
Yeah.
again, there's only like, I always say to founders, there's only like a handful of things to care about in those, term sheets and in the, closing docs and sub agreements and bylaws. And, a lot of times, like, that's not what the VCs want you to pay attention to. Right? It's actually
Yeah. Right.
it's like the opposite of that. I remember I learned this at Dime. We had like a literally like a multi-$100 million difference in one of our funding rounds. Late stage growth equity,
Yeah. Yeah.
private equity.
Mhm.
Where it was like literally like one valuation was like, 400 million, one valuation was 250 million. I'm like, why aren't we taking the $400 million valuation? And they're like, oh, let me explain to you what a 3x lick pref looks like.
Yeah. Right.
and how big this thing needs to get before you, common shareholder, who's killed yourself and bet your entire future and your entire net worth is a liquid in this company.
Right.
Let me
Yeah.
explain to you what it would do if we took that. Right. And it was
Yeah,
like,
the
oh,
structure
crap.
that creates different risk in there. And that's another thing we don't see when the clapping of the $100 million round. We don't see that how much of it went to the founders is secondary. We don't see you would imagine like 100 million, there's as you described, there's totally different structure.
And I will
100
tell you
million.
that it's not just founders taking secondary. And for those on the call, secondary means money that doesn't hit the balance sheet, right? Money that goes to
Yeah, founders taking money out, paying back their
But
investment.
one thing I've realized more and more and more is, it's not always like the founder who's still there, right? It's someone who was there 7 years ago who left and had 8% and, is off, working at Google as an engineer, right?
Yeah.
It's also a lot of early stage angels and early stage like local seed
Right.
funds, like
They get cleared out.
way more of the later stage rounds or those large rounds, way more than you think is actually rows of the cap table selling their positions or selling down their positions, right?
Right.
Even if they're not selling 100%, if I'm a early stage, seed fund or angel group, and I got in at the 10 million valuation you mentioned, and now it's a $300 million valuation. Well, I can roll 20%, but make what the math would be on that with dilution, but I can make a 20x and then ride the 20% on the maybe the fact that you might go to IPO, right? And so there's so much of that going on, way more than I think I realized. I always thought of it as like the founder selling or founders that left selling or founders who are there diversifying. it's more so the rest of the cap table and again, everyone, the thing is, like, these cap tables aren't usually clean. Like, even if you're a practical founder, like, it's not a straight line for growth and success in startups. Like, a lot of, it's
Yeah.
like a problem with a lot of these, like, safe rounds, simple agreement for
Hey.
future equity or convertible notes, or a lot of times they get stacked on each other, and
Mhm.
they're used because they're easy to get the 50K or 100K or 250K from your neighbor or your dentist or a lawyer, right? But in the end, that eventually needs to convert to something, and
Yeah.
and the math on that is never as pretty or
Right.
as simple as you put on the whiteboard or on a post-it note.
Yeah, totally get it. And so, and that's we did a once around on your practical funding approach and the difference between the classic VC funding that we all hear about here. Let's talk about the actual game of growing
Yeah,
a software company, not the funding game, the building product, getting customers, growing revenue, building a business, improving the business, and the game here. You spent years on the go-to-market side. You're not an
yep,
engineer, technical
yep.
founder. Presumably, you got your chops with product and
Oh yeah,
and
yep,
so forth. But and you actually in your services arm does build product and
yeah,
you
totally.
do dev services and so forth here. But let's talk about the modern software go-to-market, which is where all the action is. What kinds of things are you doing for the founders in your services arm around the go-to-market?
Yeah, well, before I answer that, I mean, I think one thing that I saw, and when I took my first CRO gig, right, when I was in my mid 20s, which was a breach at
Hmm.
Dine, which
Yeah,
ended up working out. but
yeah, yeah.
but when I took it, the reason I took it is because I was at an ed tech software company where two of its founding team members were the CMO and the CRO, and or the SVP of sales and SVP of marketing.
Wow.
And I felt like, especially in SaaS businesses, subscription revenue models, the left foot, right foot, just in go to market, obviously need to know what the other is doing, and operate with a
Sales and
standard
marketing.
sales and marketing and CS, right, and
Hmm.
BD and partnerships and
Yeah.
all these things, right, and I think what I saw, and that was my, like, what I saw and what I seeked and what I got at Dime, right. I was a CRO before that title was cool, and it was everything: sales,
So,
marketing, biz
yeah.
dev, right, all of it, and in customer success and the likes. So what I didn't appreciate as much, especially when I got into Dine, was that we were like an infrastructure technology solution, right? So we specialized in the domain name system, the DNS, and the value prop of DNS was faster, more secure, more reliable websites and apps, right? And if you were an internet brand or you operated online, so e-commerce, SaaS businesses, media sites, you needed the fastest website and the most highly performant and the most secure website, and that was Dine's business value prop. I learned right away that I had to get deeply technical, and I needed to truly understand not just the app, the UI UX, like workflows of
Hmm.
the product, but the deep underlying tech specs of the product, the architecture, the IP, and like why you couldn't build this yourself, or
Yeah.
why we were better than the market players that we were up against as we scaled. And that really manifested its way into, in the early innings, it was technical founders and engineers, and both CEOs I worked for, CEO founders, were engineers, being the kind of go-to-market complement of them. And that was the manifestation of launching York IE. I was like, man, there's so many technical founders out there who need help
Mm.
on go-to-market, business scaling, and all that. That still remains true. I want to be very clear.
Yeah.
But with modern tooling and cloud computing and SaaS and global workforces and offshore dev and all these things, you're seeing more and more traditional legacy industries bring founders who have operated in those industries in different roles and functions, want to go build software and automation and AI and technology to make those industries more efficient and effective at what they do, right?
Yeah.
And so that's what led us to this, like, more holistic approach to York IE and the advisory as a service side of having go to market, R&D, G&A service capability, because these things are also connected in a subscription business model, right?
Well,
Like,
we could say
who
that's one of the big changes. It used to be the sales and marketing side founders and the technical founders there, but yes, you can build product these days. That's figure outable, and I say you can, the go-to-market is the trickier part, but the more primary thing is finding a problem in the world that people care about and will spend money on. And you're kind of supporting those industry problem experts that want to become entrepreneurs that are
Yeah,
neither technical or sales and marketing yet.
and you're right. We're beyond like I don't know if this is showing up on video, but we're beyond the widgets where I have an Amazon Fire Stick and an Apple AirPods. Like, okay, go sell and market this, right?
Yeah.
Like, come on. Like,
Yeah.
I think like the number one metric for subscription software businesses today is net retention, right?
Yes.
Like, how do you have how do you make more money next year than you made this year from the client base you have, right? Like, you're
Right.
not going to keep every client, but if you expand a ton of clients and provide more value, and so I think like the biggest shift is like the feeds and speeds selling approach, like the feature function selling approach is so long gone. And that used to be like value talked about as like value-based selling and used to only think about in like enterprise. But now it's like, what is the business value proposition? What is the ROI of your capability? How do you
Yeah.
help me make more money
What
or
will
spend
this do
less
for
money?
me? Yeah. Yeah.
Yeah. And like that's an entire shift. And that's gone all the way down to the prosumer or PLG motion,
Yeah.
all the way to the SMB, to the mid market, to the enterprise. Like, you damn well better come with business value and business ROI. And how do you help my business be successful, regardless of if it's an infrastructure or cyber solution or a vertical application, right? You have to come with that approach. So I think that's the biggest thing I've seen is like, you can't bring in force management or Sandler or Serious Decisions or whatever to teach you how to sell JP Morgan and Wells
Yeah.
Fargo and Pfizer. You need to actually have a deep understanding of your market and industry, have a deep understanding of the buyer, the repeatable use cases, and the business value proposition in those industries, and focus, right? And focus and do it over and over and over again. And that's a tricky thing. And the problem is if you're the industry domain expert, you sort of like know exactly what the market needs, right? Or that's what you
Right.
think. If you're the product founder, you're like, well, I know what I can build to satisfy the market, and those things getting married is what builds successful subscription, scalable,
Yeah.
high enterprise value creation businesses. Whether you're going practical route, pragmatic, we call it pragmatic growth,
Yeah.
or
Okay.
you're
There you go.
going VC playbook, right?
Yeah.
Like depending, no matter the track, like the left foot, right foot, the whole engine needs to be connected. Like, and
Yeah.
if I've been thinking a lot lately about like pricing and packaging is sort of like the central core that
The
connects go to
crux.
market
Yeah.
to finance and ops to tech. Like, and so much of how you price and package in a more consumption based, usage based business models is attached to product capability and billing capability and
Yeah.
and retention and feature set. And that's why I think the even though it's I could talk to you at length about sales motions and go to market, top of funnel strategies and all that. It's, for me, it's become way more integrated than it ever was. And
Yes.
if you're not like more of a CXO at the top, even if you have a
Right.
functional area of
Yeah.
expertise, like if you're a CMO and you don't understand tech, get the hell out of that company. If you're
Right.
a CTO and doesn't understand sales and can't support the sales motions, get the hell out of that company. And that's what I challenge even the York IE executive team that's fully built.
Yeah.
Hey, I get your function, but like, think more broadly all the time and make sure that the decisions you make are in concert with the decisions and the collaboration of the rest of the organization.
Yeah, I want our listeners to understand how important that is and how evolved that is from the old days of software. There was technical people, and then they threw it to sales, and sales pushed it out there before the SaaS business model. And their business model was, you got all your revenue up front in the old license days, early 2000s and before that. And then you got a little bit of maintenance contract out of it, but it was all up front. This DNA of SaaS has moved the real value, as you described. The real measure of success is how happy your previous customers are, not how fast you coded and how well you sold them. It's how successful they are at getting their ROI and spending more with you, which is a complete reversal in the business model and DNA of a business. So you have to be integrated and not just have this, whatever hierarchy, tech to sales to support, that game. You have to build all these things together at the same time. So And it's actually the superpower of practical founders who see
Yes.
all of that, the problem, the finances, the code, the go-to-market, and that puzzle is it's a massive opportunity. That's where the leverage is for founders
Yes.
is, yeah.
I have two reactions to that. I think like in your point in the license maintenance mode, think about what like the customer org looked like back in the day, right? It
Yeah.
was like support, bug fixes, code releases, like it was reactive, right? It was
Yeah.
like
Support. Yeah.
right, like it was reactive, and it was part of your cost of goods sold, but it was like it was a small engine, it was
Right.
like you'd
Last on
have
list.
like you'd have help desks in the Philippines or whatever, right? And it would just be like whatever, like we just need to do support. Right.
Yeah.
And now it's a very proactive function when you think of like customer success and customer engagement, customer relationship management, account management. Like it's much more like embedded and ingrained in the
Yeah.
client perspective. Like think about the feedback loops of client to product. It's actually going through customer success, and it's less straight reactive because it's a business model. If you're good at it, you're rolling out feature enhancements and new products and new capabilities and along the way, right? Like it's not like once a year or hey, we're going to put out the iPhone 17 and whatever in 2 years, right? No, it's like every day you should be deploying code, and that's the agile development model. All the feedback of that two ways runs through this customer success
Yeah.
team and
Mhm.
many times into your sales and account management team. And that's not just for enterprise selling motions anymore.
Right.
That's all the way down to low ACV, down market
No touch,
products.
PLG, small
Yeah.
business software. Yeah. Yeah.
Yep.
That's awesome. Let's talk about the go-to-market part of it. I mean, it's
Yep.
2024, post-COVID. The economy is slowing down. SaaS buying is slowing down. Almost all the founders I know are dealing with, wow, things just slowed down this year, and we have enough product to sell, but not enough customers, revenue growth, pipeline, all that kind of thing. Let's talk about the go-to-market modern approach here. It seems like almost every tactic that worked 5 years ago, outbound,
Yep.
SEO, paid ads, sales, just add salespeople, just the things that funding can buy, right? Just throw
Yep.
money at it. It's like those things don't work very well anymore. LinkedIn is dead, and social in a lot of ways. So what are you seeing this year, and how are you helping founders get through the go to market? What's working to create growth?
Well, first of all, I think you're seeing like a return a little bit to brand, which
Oh,
like brand, community, like awareness, visibility. Like it's also why I think you're seeing so much like vertical SaaS acceleration, because it's sort of like, all right, I can go to if I'm we have a couple businesses in supply chain and food and restaurants. Like, well, guess what? There's
to the
5
trade show.
shows a year, and there's like traditional like paper magazine rags that are exist, and there's like community groups and Slack groups and LinkedIn channels that are more targeted and explicit. And if you can go in there with a true business value driver of either top line or
Yeah,
efficiency and stand out, people will listen, right? Because everybody's looking for how do I add more revenue or how do I cut more costs? And if you can come in with that business value driver that's a little bit more targeted, again, it's back to like what's old is new again. Can you stand out by building brand? Can you stand out at getting into events, even if those events are digital events? You got to get in front of the right buyer and the right audience. I think it's very, very the stuff like downstack, like PLG or like consumer tech or these types of things. I really struggle with because the way that those things historically have gotten to be big, right? The Ubers, the Airbnbs,
yeah.
you insert any brand is by either getting super damn lucky, right? Catching lightning in a bottle, or raising $300 million in arbitraging Instagram ads or
To
Facebook
build a
ads,
brand
right?
and get in
Yeah.
front of everybody. Yeah,
And that's in like we do B2B SaaS, right? So it's like a lot of times when we look at B2B SaaS, we try to like eliminate consumer risk and eliminate like the binary, like if we're not lucky or we can't find the VC path, we're dead, right?
yeah,
So like what's the point and shoot go to market? Yeah, that's a term I use. I don't know if that's
yeah.
like an industry. What is your point and shoot go to market? Like is there a list you can cultivate? Are there events? Are there places you can go? Is there a community that you can build that's targeted where you get away from like sort of the historical metrics of like if you close like a quarter or a third of your pipeline, you're great, right? How about we get into a world where you can try to close 70% of your pipeline because you're actually talking to the right companies in the right market segment, the right buyer with the right use case, with the right repeatable value prop. And so again, I think that connection is just much it's needed to become much more crisper. You also have way more B2B tech businesses, way more SaaS businesses, right? So there's a
Very
lot of
crowded.
noise,
Yeah.
very crowded. So if you don't differentiate through brand and messaging and storytelling and events and community, you're in deep trouble. So it's like I used to always call it like you had to nail your owned media channels before you get
Uh,
to your earned media channels, before you get to paid media channels from your top of stack marketing demand gen, top of funnel. I think that's kind of back in vogue, right? Where
yeah.
for a
Yeah.
long time it was like, how do you pay for it? How do you buy it? How do you go more
Right.
owned and do BDR outbound, or qualification of inbound from paid media, right? It's a different game. I also think like what I've been seeing is I don't think like I'm not as aggressive that like BDR is dead. I just think the role of the BDR is different, right? Like it's a I've always tried to affix it. It's a little bit of a ping pong ball, but I've always tried to affix it a little bit more to marketing, right, and
Yeah.
qualification and
Yeah.
education, and that's a tricky thing to do, right? When you think of like the BDR role as like an entry level role, and everything else we discussed earlier about like needing to be a market
So
expert, needing to
deep.
be a tech
Yeah.
expert, need to
Yeah.
go super deep, and then like you're putting a bunch of 22-year-olds on the phone hammering people, right? So I don't know. I think it's just it's about all those sort of like things that come with being an expert and making sure that everybody's armed to be an expert and making sure you're driving business value in the selling motion in the sales pipeline process and making sure everybody's equipped to do that because you're fishing hopefully in more stock ponds than just like the universe is your greenfield opportunity. It's funny when I look back on it, like even when we built Dine I go back to like 2009 when we were just going B2B, we still picked 5 verticals, even though anybody with a website, any industry in
Yeah.
the
Yeah.
world, any
Mhm.
size company, we still like defined like these market segments, these industry verticals, these target buyer personas, these repeatable use cases, these business value propositions. Like those were defined. And yeah, on inbound, we'd still work with stuff that was outside those key verticals if they came to us, right? And then we could figure out a solution. But everything we did from a top of funnel demand generation to outbound to positioning on the website, messaging to sales collateral was attached to those core verticals that we thought personified the best business value proposition of the business. And so I think getting back to that
Yeah.
and it's not like growth at all costs and you can't just buy it anymore and like just build your quota model and your BDR model and just run hard because you don't care about efficiency or
Yeah.
CAC,
Right.
right? You have to be more efficient. So I think it's a marriage of those things that I think drives hopefully efficiency.
Well, isn't it interesting how, in let's say the SaaS run up 2015 on, right, all the way through COVID, is that we've got a product that we're going wide for everybody and we raise a ton of money and we throw a bunch of money at it, kind of worked for a while, but, meaning to get some growth and so
Yep.
forth. Maybe it didn't work in the long run. And some people lucked out in COVID that the world turned their way and investors,
Right.
buyers were there, that kind of thing. But it doesn't really work that way anymore. You can't brute force your way to growth in all directions with funding and tactical spending.
Yep.
You've got to, as you say, create leverage through focus that makes you an expert and has people perceive you as an expert.
Yep.
Do you help with that focus therapy where they say, because it's fundamental to the leverage of a business,
Yeah,
which is
totally.
we could sell to everybody, but we're going to focus and narrow in. It's just a proactive decision on the ones where we can be most efficient and most effective in the long run. That's the superpower of the growth game, getting to 10
Yeah,
million.
in our go-to-market practice, we have the way we've done it is sort of we have the go-to-market practice. In the go-to-market practice, we have different functions or service
Yeah, sure.
modules, and each one of those functions and service modules has different tiers of service based on the depth of need you have, right?
Yeah.
So, one of those is go-to-market strategy.
Yeah.
Another
Yeah.
one of those is marketing. Another one of those is website and digital. Another one of those is RevOps, right?
Yeah.
And so we tend to we've tried to like almost widgetize our tech-enabled services, right? So you could come in and say, hey, I really need help on go-to-market strategy. I might be a tier 4 go-to-market strategy, and I need your CRO, CMO level guidance to help
Hmm.
me define all these things. But I also need tier 1 RevOps. I need tier 1 digital, and we build packages like a SaaS vendor would
Yeah,
of
right.
different
A la carte.
capabilities that you need at different tiers, right?
Yeah.
So absolutely, we work incredibly hard on that. I mean, we work really hard at like pressure pointing that in our investment diligence process, right? Pressure
Hmm.
point, pressure point, pressure point, get focused, narrow in. I want to believe your TAM, but I'd rather believe that you're going to hit 20 clients by the end of the year and,
Right.
hit 400K ARR. You know what I mean? So it's a probably a better connection to like the bottoms up scaling
There we
plan
go. Yeah.
and than it is like just so many VCs are just like, what's your TAM? And it's like, everyone's going to tell you they have a multi-billion-dollar TAM. Like Jesus, like if they're on the venture track and they don't tell you that, then they're not. They should be on the venture track, right?
Right.
But I'd rather see like, tell me how you're going to get to 20 clients. Tell me how you're going to get to 50
Yeah.
clients. Tell me how you're going to get to 100 clients. Like, tell me what your average ARR per customer is. Tell me what your retention assumptions are. Tell us what your expansion assumptions are, right? Like, tell us, can you do that in the current target audience that you're talking to today, right? Like, and so it's much more like
Yeah.
practical bottoms up than it is
Yeah.
anything else. So yeah, so we definitely go deep there. It's a big part of our thing. Another one of those modules is pricing and packaging, because again, I mentioned that earlier, it's attached to it. And it actually is what
It's
kind of
complicated.
starts to
Yeah.
pull in your product and technical leadership as well.
Yeah. Yeah, pricing and packaging touches everything. So it's I just love that integrated approach, and the business building and your practical approach there. 100% of ventures that think they're going to be $1 billion, if they don't get to $10 million, they don't get to $1 billion. So you got
Yeah.
to got to focus there. So appreciate your practical approach. Let's talk about one more thing here on the list here. How are you thinking about with your company and your investment portfolio, AI, the
Yep.
buzzword, the hype, I don't know. Most VCs require an AI story to invest these days, and so forth. But you're practical. How
Yeah.
are you thinking about it from an investment and operational standpoint?
Yeah, I mean, there's a few things. I mean, we ask questions like, how are you leveraging AI to make your company more efficient and effective, right?
Yeah, yeah, yeah.
We ask things like, how are you thinking about AI as it relates to your own product,
Right.
and platform and improvements? And then how are you thinking of AI as an industry, right? So we
Yeah,
ask like the same questions you're kind of asking me,
yeah,
right? The from the standpoint of our investments and advisory business, like, we believe that like, we're not investing in like AI chip companies or something, right? Like,
yeah.
we look at it more as like, are you leveraging AI as part of your platform to make your platform more sticky? Are you leveraging AI to lower your COGS and your costs of R&D in your platform? Or are you using AI to launch a new feature capability in your platform that you'll
Hmm.
charge for? Most of the time in the stuff we're just seeing it in a much more like the platform has some elements of AI, right?
Yeah. It's a
Versus in
technical technology, just a feature.
it's a
Like, yeah,
technology.
yeah.
It's like, AI to us, and maybe this is because of our heritage and infrastructure and cyber and data.
Ah,
It's like, looking at it like the AI is only as good as the data sets you have and the unique proprietary data collection engines you have.
right.
And we look at it a lot more from like data architecture and like UI and UX and workflows and business value, right? And so a lot of our conversations are like, it's back to laughing, but it's back to pricing and packaging. Like,
Yeah.
is any of those AI capabilities actually like just make your product better, or are you going to try to charge for them? And too often you're seeing people like student bodies shift to like leveraging, Chat GPT or Gen AI and say like,
Yeah, yeah.
our whole company is now an AI company. And it's like, well, you don't have unique proprietary data. You don't have a plan to get unique proprietary data. Your company value prop is not attached to that. Like, why are you buying a .ai and changing your branding?
Yeah, yeah.
So we're looking at, again, back to everything else, practical, pragmatic. We want to, in most spaces, we want to see like some play there, but there's also like back to upstack vertical apps that we invest in. These industries are so archaic many times and
Yeah,
so behind the
yeah.
times in basic technology adoption that like if I hear too much of an AI story in the meat processing industry or the electronic component parts pricing industry, or the, like some of these industries, like it's not about AI right now, right? It's about like
Yeah.
literally creating an integrated software platform to automate workflows, or to just get smarter. So like, it's nice that there's AI components, but if you over student body position and you're selling a CNC machine shop, they're going to be like, get the hell out of here. Like, I don't worry about AI. I just want to have like dashboards, analytics dashboards on my shop room floor, right? So I just think it's got to be balanced. Again, attaching all to the positioning of the company, the use cases, the value propositions. But again, you'll laugh. You'll go look at our portfolio after, and you'll see a lot of .AIs, and you'll see a lot of companies
Yeah.
with AI in their name. I mean, one of our biggest high flyers is called Cranium AI, and it's a cyber company doing cybersecurity of your LLM models and of your AI, right?
Oh, right.
And it's like when we
Selling
saw
picks and
that.
shovels, to the gold mine.
Totally,
Yeah.
exactly. And these guys spun out a KPMG, so it's a big enterprise play. And it's like, hey, your teams are implementing AI for internal operations and
Yeah.
across IT, and they're implementing AI and customer support and CS. They're
Makes
implementing
sense.
AI and go to market. They're implementing AI in your products and platforms. Do you know
You
what the
really know
AI
what's
is
going
doing?
on. Yeah.
Yeah. And so I think that one has raised a lot of money. It's like one
Oh,
of the ones.
yeah.
It's one of those ones that like went from like, yeah, we're practical, but like, hey, this
Let's
market just
go.
opened up for us. Let's go, and
Yeah.
we are gonna support that. And that's actually one. Business Insider asked us like, who's like the hottest company that you've seen lately, and that's the one I
Yeah.
called
Yeah.
out.
That's fun. And isn't that interesting? That's
No
a media
offense.
place.
No offense. I didn't call out the 200K bootstrapped ARR business with a $10 million TAM, right? But I still believe that company can be big, right?
Yeah. Yeah.
So
Right. I think that just the outside in of investors and media and the rest saying, I only want to talk about the explosion, blockbuster hits, creates a lot of opportunity for practical founders, because there's a lot of small TAM markets that are just amazing that VCs can never invest in. So,
well, listen, the other thing that's happened in those industries that no one's talking about enough, and it's funny that I'm going to like kind of wrap on this point, but like, how many industries are like traditional industries like are being rolled up by private equity, and you
dental
use
offices, all that thing.
dental
Yeah.
offices,
Roofing. Yeah.
funeral homes, car washes, HVAC vendors, fire suppression vendors, like. So like you're actually ending up with like what used to be like mom and pop Main Street SMB, like that's true too. You can go build the go to
Mhm.
market to attach to them, but there's also like enterprise selling going on because there's private
Yeah.
equity who's rolling up thousands of
Yeah. That's
those,
dental
right?
DSOs. Yeah.
Yeah, so it's a really really interesting, and that's happening in like literally every industry. Like I laughed at like anybody today who tells me they got their MBA, they either work at a private equity firm or they're going to go buy a 1 to 5 million EBITDA HVAC company and run it, right? That's what you use your MBA for these days, right?
Yeah. Right.
And so but that has changed the total addressable market and the scale
Ah,
potential of a lot of vertical industry software solutions.
that's very interesting. Okay, Kyle, we covered a lot of ground here. Thanks for sharing your insights about your practical funding path and how you operate there, and what where the leverage is in modern growth for SaaS companies. What advice do you have most often for practical SaaS founders getting on the field, whether they're thinking about funding or not, right, and doing it themselves? What advice is what's your best advice for these founders as they're getting started, getting to on the field, getting to 1 million ARR?
Yeah, I mean, uh, it's going to sound so simple, but like set the vision
Yeah.
long, what you want to be and what you want to build, and make sure that every decision you make backwards to today is working towards fulfilling that vision, right? Because
Mm.
what I see too often is companies like pigeonhole themselves down a certain trajectory or path that isn't even aligned exactly with what they wanted. And, when you're, like I said, when you're raising money from outside people,
Right. The
just
trap.
understand their expectations. It's a trap, right? And again, there's nothing wrong with either path. Just make sure it's the one for you.
There we go. Appreciate that. How can people reach out to you or talk to York IE, your team, about funding or some of the various services that you offer to SaaS companies of all sizes?
Yeah, great. So our website is york.ie. We're at York Growth across all social channels. I'm KYork20 on Twitter. We're kind of, now that you know us and you've heard us, we're sort of everywhere.
Hmm.
bury your your feed, but we would love to talk. I mean, we've tried to democratize a lot of what we're doing. We have even a self-service platform called Fuel for advisory. You don't need to necessarily pay us money to get value from us. So
Yeah, you
hopefully we
publish a
can
lot of
connect
great
there.
content that's very
Thank you.
useful to founders there. So I appreciate you being on the Practical Founders podcast, Kyle. Thanks for sharing your insights.
Thank you, Greg.